All right, welcome to The Explainer. Today, we are going to tackle a topic that's the absolute foundation of any business out there. I don't care if it's a tiny coffee stand or a massive global company. We're talking about bookkeeping. You can think of it as the language of business. And you know what? By the end of this, you're going to be well on your way to speaking it.
Okay, so let's just dive right in with a big question. Picture a business. It's got stuff, right? Machines, maybe a building, cash in the bank, but it also owes people money, loans, bills, you name it. How on earth does it keep track of all that without everything just turning into total chaos? How does it actually know if it's making any money?
Well, the answer is it tells a story, a financial story. And just like any great story, it has to follow a certain structure, a set of rules that holds it all together. And the most important rule of all is one simple golden rule.
This right here, this is the rule that the entire system is built on. It's the key that makes the whole financial story make sense.
And here it is, assets equal liabilities plus capital. So what does that mean? Well, assets are all the useful things a business owns, cash, buildings, that kind of thing. Liabilities are what the business owes to other people, like a bank loan. And capital, that's what the owners themselves have put into the business. Now here's the kicker. This equation always has to be perfectly balanced. Always.
Let's make this real. Let's look at a fictional startup. We'll call it RT Limited. On the right side, you see all its assets. Machinery, a building, cash, all totaling up to 13.5 lakh rupees. Now, look at the left side. You've got its liabilities, that bank loan, and the owner's capital. And, which you look at that, the total is also 13.5 lakh rupees. See? Assets equal liabilities plus capital. It balances perfectly.
Okay, so how do we keep that beautiful equation in balance when stuff is happening every single day? Well, that brings us to the first step of the process, and I want you to think of it like keeping a diary.
So let's say our company, RT Limited, makes a move. It buys 10,000 rupees worth of goods. Let's call it inventory, and it pays with cash. Super simple, everyday transaction, right? But what does this do to our golden rule?
This is where the magic happens. It's called the dual effect, and it's the secret sauce that keeps everything in balance. The company's inventory, which is an asset, goes up by 10,000. But at the exact same time, its cash, which is another asset, goes down by 10,000. So really, one asset was just swapped for another one of the exact same value. The total value of assets didn't change at all. So our equation, still perfectly balanced.
Now this process, recording this dual effect for every single transaction, happens in a place called the journal. And honestly, the best way to remember it is to just think of it as the business's diary. Every financial event, big or small, gets written down here, in order, as it happens. It's the very first place the story gets recorded.
Making an entry in this diary, it's got a fancy name, journalizing, is really just a simple three-step process. First, you figure out the two accounts that were affected. In our example, that was inventory and cash. Second, you apply the rules of debit and credit. Now, don't let those words scare you. Just think of them as the left and right columns in our diary. For things to balance, a debit to one account needs an equal credit to another. Simple as that. And third, you just write it all down with the date and a quick note about what happened.
And here's what that diary entry actually looks like. We debit the purchases account to show that asset went up, and we credit the cash account to show that asset went down. See how the debit and credit amounts are exactly the same? That's the balance right there. This is the official entry in our business diary.
Okay, so we've got this super detailed diary, recording everything day by day. But a diary isn't very useful if you want to ask a question like, hey, how much cash did we spend in total this month? You'd have to flip through every single page. That's a nightmare. So we need to get organized, and for that, we're heading to the library.
The ledger is the company's financial library. After an event gets logged in the diary, that information then gets posted or sorted into the correct book in this library. So there's a book for cash, a separate one for sales, another for loans. You get the idea. This is where we group all the similar transactions together.
For example, let's look at the book just for cash. On the left side, the debit side, we track all the cash that came in. And on the right side, the credit side, we track all the cash that went out.
By adding up both sides, we can figure out the final balance in a snap. This one page tells us at a glance exactly how much cash the business has. So much easier than reading the whole diary, right?
So, we did all this work. We recorded everything in our diary. We organized it all in our library. Why? Why go to all this trouble? Because now we can finally sit down and read the complete financial story of the business.
All of this detailed, organized information, it's the raw material for the most important documents a business can create. These are the final reports that tell the owners, the banks, the investors, what is really going on inside the company.
And it really comes down to two main reports. First, you have the profit and loss account. That tells the story of performance over a period of time. You know, did we actually make money this year or not? And then there's the balance sheet. We saw that one earlier. It's that financial snapshot, a picture of what the company owns and owes on one single day. It's the ultimate test of our golden rule.
Okay, so let's boil this all down. What do you really need to remember? First, that accounting equation. Assets equals liabilities plus capital. It is the rock-solid foundation, and it always has to balance. Second, every single transaction has two equal and opposite effects. And finally, just remember that simple analogy. The journal is the business's diary, where you record things as they happen, and the ledger is the business's library, where you organize everything.
So we've seen the nuts and bolts of how a business records its past. But the real power, the reason this all matters, is using that story to look forward. So I'll leave you with this to think about. Now that you know how this financial story gets written, what kind of clues do you think it might hold about where that company is headed next?